Atocha Global Analytics. Please like and subscribe.
Okay, as the media and other so-called experts have now realized the potential threat posed by the revaluation of commercial real estate after the Fed dramatically increased interest rates during the last year, let's examine a case study that highlights what happened during and because of the Great Financial Crisis and Great Recession to see how an office property performed during a crisis like the one we foresee coming at us now. When the Great Financial Crisis set in, it was before I began sourcing real estate assets and doing acquisition modeling. At the time, I owned a company specializing in appraising large and unique commercial properties. I happened to also do a lot of expert witness testimony work during this time frame, and one property I appraised for an attorney friend of mine was a 4,000 square foot, 2-unit office building managed by a local broker that I had a good rapport with. Here, I'm going to show you the breakdown of the financials on that property. Plus, I'll show you how the broker handled renting the space within the declining market in the years before the real estate recovery began in earnest. But first, let's cover how commercial leasing works for those that may not know. The terms gross and triple net may not be familiar to some of you, so here's a table to indicate how commercial rents work. In these 4 columns, the lease structure is described in the left column. The next 2 columns show what party pays what, and lastly, how the expenses skew is to the right. Excluded from the table is CAM, which stands for Common Area Maintenance, which is an umbrella term that some of the costs noted on the table are included in. For simplicity, I've just expressed the expenses so things are straightforward and not complicated with more esoteric breakdowns. A quick note about triple net. The owner-landlord still has to pay financing costs and replacement reserves under that structure. For those that aren't familiar with the leasing terms, I want to highlight 2 that were used. If you hear gross, you need to think that the landlord is paying several or most of the items, the expenses. If you hear single net, the tenant pays a single category of expenses, double is 2, and with triple the tenant pays 3. Even if it's new to you, the terms are pretty logically defined. I've structured the finances here to show items as cash flows associated with the property. The rental income collected by the landlord is expressed here as $20 per square foot, which is the annualized base rent divided by the square footage that's leased. And the expenses could be paid either by the tenant or landlord depending on how the lease is structured. So when you take all these line items, annualize them, and divide them by the building square footage, or the lease, in this case, it's also the leased square footage, you get $38.60 per square foot. The base rent, or the rent that the tenant pays the landlord, may only be $20 per square foot, but everything else, excluding financing and replacement reserves, equates to another $18.60 per square foot. With the triple net structure, the tenant pays $32.60 per square foot. That's $20 per square foot plus another $12.60. And the landlord received the base rent of $20 per square foot and paid financing costs and replacement reserves out of that. That's the structure and the income and expenses circa 2007 for this property. Now, just to expand on how the different structures look, I've shown here how these expenses might shift around depending on how the parties might structure a lease. Absolute gross means the base rent is all the tenant pays, and with modified gross, they also end up paying utilities. The table proceeds to the right where the effective cost to the tenant goes up with each incrementally to a maximum of $32.60 per square foot with the triple net term. $32.60 is the annualized cost of all those items divided by the lease square footage. I've excluded replacement reserves here as it is almost always paid by the landlord or owner and would not be a factor in the lease terms. Similarly, financing costs are not included in any of this because the landlord or owner always pays that as well. So here's the insightful part about the way things were handled during the Great Financial Crisis. As vacancy increased and landlords or managers had to make concessions to lease up their empty space, they started being creative in how they conceded. They offered 3 months of rent to start with, but it wasn't good enough for very long. Soon they were forced to change the structure and start to pay the property expenses the tenants had been paying previously. That's what the broker did with this property, and it was very common. Everybody was having to do it. Starting in 2007, the tenant in this property, renting both units, was paying rent and the triple net expenses, or $32.60 per square foot in this case study example. By 2011, the space had become vacant and was rented again to two tenants at $18 a square foot for each unit. But it was now modified gross, with the tenants paying base rent and utilities only. Note that the base rent, which is the advertised rental rate, only went down 10%. I'd say 10% doesn't look like much, but here's the huge caveat. The landlord was now collecting $18 per square foot, but paying an additional $10.20 in expenses that they hadn't been paying before. This means the landlord only got about 24% of what they had been getting just 7 years prior. Remember, the owner still had to cover reserves and financing costs, so they were basically losing money for a few years during and after the Great Recession. I show this as a case study of how it all happened before, because despite what the policymakers are telling us, we are seeing all the same storm clouds forming again. Now let's fast forward to 2023. Some areas of the U.S. are doing nearly the same as a few years ago, while others are really showing signs of strain. New York City, for example, has around 50% vacancy in their office buildings, and it's actually similar in a number of other cities. So that really looks like a potential disaster brewing. However, not every area is shockingly challenged right now. An area that I happen to be familiar with, Atlanta, is a bit in the middle. So I'm showing an example of a property from that market. So before the shutdown in 2020, the vacancy rate was a tad under 10% in Atlanta. And now in 2022, the most recent year with data, it's risen to 20%. That's a bit of a change, but not too bad when compared to New York City. Here's a concise breakdown of a 10,000 square foot office building's financials that I happen to be able to source. You can see the base rent was $23 per square foot. When the expenses are deducted, the net operating income, or the income prior to paying for any financing, and what we've commonly abbreviated as NOI in the industry, is just under half of what the property made in gross rents. Also, the property was rented triple net, with noteworthy costs being paid by the tenants. So the owner also had that benefit to the property's income. One note here is management. I noted that the 10% seems somewhat high for the market, and I dug around a bit to confirm that the owner also owns the management company that is managing the property, and it's likely that he's paying the, quote, owner's management company, which is also known as themselves, an above market rate as a strategic move. All right, so fast forward to 2022. The base rent and the rest of the financials remain the same, but vacancy in 2022 in the Atlanta metro is up to 20% now. So the NOI is down 16.3%. This is critical because when you value real estate via what's called the income capitalization approach, commonly called simply the income approach, you divide the NOI by a capitalization rate to estimate the value. If NOI declines, then the property's value via that approach is also declined. If we fast forward to what it might look like in 2024 with a recession and financing challenges on the horizon, and the decline would logically get even more pronounced. Just like the 2007 to 2014 case study we just looked at, we'll likely see the headline price per square foot stay high for as long as possible, but the vacancy rate they must model it with goes up, as vacancy will almost certainly increase during a recession. At a projected 25%, which is only 5% higher than 2022, that is likely a bit conservative for potentially 18 months in the future and in a severe recession, but I don't want this to be a worst case scenario. So the base rent, less 25% vacancy and collection losses, further erodes the income. Again, to remain consistent with the case study, the potential lease in 2024 might only be a double net lease. So one item was added as a cash flow expense in order to reflect this transition. Based on the new model and all other expenses remaining the same, including maintaining the same basic reserve replacement, the NOI drops another 36.8% from 2022. That's a cumulative decline of 47.1% overall from 2020 to 2024. However, that's not all that's happening to impact values. I mentioned capitalization rates or cap rates. They have been impacted from 2020 to 2022. Even if you were making the same NOI, the capitalization rate has adversely impacted values by 6.52% within the calendar year 2022 alone. That means that the value via the income approach, which lenders, owners, and regulators all care about, is down from $2.2 million to $1.6 million from 2020 to 2022. That's just 2 years. That means the 16% in NOI decline is really a 27% decline in value. If we extrapolate out to the 2024 projection, with the decreased NOI and continued increases in the cap rates, the value decrease becomes 57.7%. That's almost 60% lower in property value in less than 5 years. Just to interject here, there are 3 appraisal approaches to value they focus on: the cost approach, the income capitalization or income approach, and the sales comparison approach. Lenders worry primarily about the income and sales comparison approaches. The value of the income approach may fall 57%, but everybody expects the economic factors to be short-lived and things to improve again, so buyers and sellers of these properties may be willing to pay somewhat more than the 43% of the 2020 value that's reflected via the income approach. They may pay 60, 65%, or even a bit more with the expectation of the future income improving, so therefore the value improving. So that is why you're hearing about these anticipated 40% declines in commercial real estate. They know how this happened before, and they know it will likely happen again. Now you also know the financial mechanics at the property level of how this happened before and how it seems to be unfolding again. And with a Paul Harvey moment, now for the rest of the story that nobody else seems to mention. What about this inflation everybody is talking about? In 2007 through 2014, inflation really didn't hit the economy very hard. The government headline inflation averaged about 2% per year. So in theory, if rents were keeping up with inflation, then the asking rent per square foot shouldn't have remained the same, but it should have gone up. In reality, some expenses should have gone up as well, but let's not focus on the myopic just yet. Let's look at inflation since 2020 instead. We have a net inflation increase of more than 16% since 2020, and we are still at a 5% rate right now, with some property-centric additional increases like insurance costs forecasting to be well above average or well above the inflation rate over the next year or two. Extrapolating the gradual decline in inflation will continue into 2024. It's projected that the inflation in the latter half of 2024 will have been up about 24% or so cumulatively from the 2020 levels. That means that the income, expenses, and values should all have increased by almost 1/4. If many expenses have increased, then the asset value effectively declined far more in relative value than what the 40% decline in commercial real estate headline amount states on its face. The bottom line, this is big. This will impact everybody. This is in the US, Europe, and will likely travel around the globe. Atocha Global Analytics, along with Atocha Property Group and Atocha Property Advisors, is committed to bringing the decades of real-world experience in real estate analysis, plus the experience of financially modeling approximately $200 billion in real estate, to the street level for investors of all levels, so they know how to navigate these turbulent waters. Also, we include a regular segment on our channel called Policy Matters because policies matter for just this reason. The last 2 real estate bubbles were caused by distortion stemming from monetary policy, and the great financial crisis was the direct result. We're on the precipice of another crisis of possibly greater magnitude, and we need wisdom now more than ever. This video shows a real-world example of what happened before and an example of what is likely to happen again soon. both of which are reflections of a correction of the distortions caused to the market by or exacerbated by unwise policy decisions. Please like, subscribe, and hit that bell to follow and be notified of future videos from Atocha Global. In addition to real-world case studies for individual properties and advanced financial modeling of real estate, as well as actual analysis. This is actual analysis as opposed to opinion or commentary being called analysis. We have segments such as Questionable Truth of the Day and Everything is Fine that call out where news and policy aren't necessarily communicating things accurately. The aforementioned Policy Matters Because Policies Matter segment, where economic, fiscal, and monetary policies are shown for what they really are and how they really impact us, what they are not doing, what they are doing to impact the street level. And lastly, Forecast Fridays, where we share some hidden metrics that real industries use that really tells where the economy is and or where the economy is going. Thanks for watching.
Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.